Welcome back. Well, markets across Asia are in a fine mood this morning, and the SGX continues to hold on to that trend. As we told you, we'll just start getting the pre-open rates as well. In the meantime, that's a 100-point uplift. We aren't done with earnings yet. There are lots of very interesting mid-cap names that reported over the weekend. Let's go across to Rima for the lowdown. Rima?
Thanks so much for that. So I'm starting with Nazara Tech, where the growth continues to remain very strong, up 45% on year-on-year basis, and even on a quarter-on-quarter basis, it's up 6.5%. And the key is that operational improvement continues. So the company has clocked in an EBITDA of 30 crores. Rossari Biotech, very strong revenue growth. It's doubled on the top line, but margins have come under pressure. For Sarda Energy, the key has been the strong improvement in the company's operational profits. So look at the EBITDA at 32.5% this quarter. It's significantly higher on a year-on-year basis as well as on a quarter-on-quarter basis. There is an improvement of 600 basis points. Jindal saw some decline in their revenues on a sequential basis. So the second wave of COVID had an impact, but the margin improvement continued both quarter-on-quarter as well as year-on-year. Rain Industries, steady quarter, but there is a decline in the debt seen over the last 2 quarters, so that's a positive. And Relaxo, a play as the economy continues to unlock, saw strong revenue growth at 37%, of course on a low base, but margins were under pressure as raw material prices continue to spike.
Okay, got that, Rima. Thanks very much. Prakash, any of these numbers that might interest you, specifically Nazara, wanted to get your take on that one.
So, I'm glad the numbers seem to be so robust, because the rich valuations would need this kind of a performance to justify to whatever extent. It's definitely still, the only listed player in this space, and hence continues to get that premium. So if you are very decisively keen on investing into that segment, you will have to pay that price and buy it. But to me, there are far better options in terms of what offer visibility of growth for precious capital in terms of this thing, and with very limited downside risk. So Nazara could probably upset things, in terms of your portfolio returns. The drawdowns could be severe as and when things go wrong. But at this point in time, I think these numbers just give it much more room for sustaining this kind of high valuation zone. But otherwise, it's not a recommendation at this point to buy.
Okay, not a recommendation to buy Nazara Tech. Well, another pocket that I wanted to talk about was some of these pharmaceutical names, especially these Path Lab companies. Dr. Lal Path Labs posted a very strong set of Q1 earnings. It was aided, though, by the big surge that we saw in COVID testing during the second wave. Non-COVID sales growth, however, looked quite tepid at only 3% quarter-on-quarter. And now that COVID testing has fallen because the cases have gone down, would that mean some weaker earnings for them? Om Manchanda, the managing director of Dr. Lal Path Labs, joins us now to talk about that. Mr. Manchanda, good morning and thanks for joining us on CNBC TV 18. Wanted to first ask you about what the trend could look like going forward, because COVID-19 testing sales have dropped quite a bit on a month-on-month basis, and now that cases are also lower, what could the trend look like from the COVID portfolio over the next, say, quarter or so?
So good morning, Sonia. The way we normally track our business is clearly in 2 parts. One is our non-COVID business, other is COVID. And as you know, that COVID is highly unpredictable. It varies week to week, month to month. So we are completely focused on our non-COVID plans. And the way it's looking like is clearly our recovery has taken place, and we are comparing it to our pre-COVID levels. And we continue to see a normal sort of a growth trajectory in our non-COVID business. As far as COVID is concerned, you have seen that there are a lot of allied tests that have come in, which actually has led to the surge. But as you rightly mentioned, that June has seen some kind of softening, and we continue to see that happening as well. So in summary, I would say that we continue to see our normal growth trajectory in our non-COVID business.
Okay, so Dr. Manchanda, what would this mean in terms of the visibility for the year as a whole? I mean, this is still in moving parts, right? We don't know what happens to the third wave, but roughly speaking, what's the mix between the COVID business and the non-COVID business? And then where does that take your growth projection overall top line for FY22?
So in fact, it's very difficult to comment on that, given that last year we had a sharp fall in non-COVID as well. So obviously this year growth rate for non-COVID definitely would look much higher than normal growth. I think if you look at historical trends for us, we've been growing in between 14-15%. And I continue to see that if you look at CAGR over long-term basis, I think we should continue to track that kind of growth levels. And COVID will be over and above that. That's the way I look at it.
Okay. What about on the margin front? Because, you had this surge in COVID sales and that had led to record margins of 31%. I'm assuming that these are not sustainable, or rather you tell us, what could the trajectory look like?
No, absolutely. These numbers are definitely not sustainable, primarily because if you study our P&L, we have a high operating leverage and close to 45% of our block is a fixed overheads. So in any quarter or any year when the high throughput on top line happens, you suddenly see a rise in EBITDA margins. And clearly this is sort of one-off event that has happened, and that's why you see higher margins. And I clearly don't see these numbers sustainable. And as I mentioned on top line, I think our margin trajectory also should come back to normal level as we've been doing in the past, as and when COVID subsides.
Okay. Mr. Manchanda, if we talk about, the trajectory from here on, in terms of, capacity addition, fresh growth, would you be looking at more inorganic opportunities, or is growth entirely going to be led by the organic steps?
So it's going to be a combination of both. Repeatedly, I have mentioned that there are a few gaps that we need to fill our business. One gap is how do we expand our footprint in some white spaces, north and east, as well as in south and west. Clearly, north and east for us is the organic play because we enjoy a good brand franchise. In South and West, we have subsidiary by the name PathLab Unifier. We have done few acquisitions under that subsidiary, and we will continue to focus on both both inorganic and organic. And in organic direction, we have recently launched a big reference lab in Bengaluru, and we are looking at Mumbai market as well. So South and West, we'll continue to see both options, inorganic as well as organic.
Okay, just an extension to what Surbhi was asking you. You have cash on your books to the tune of around 1,150 crores. How much of that will be used for your inorganic moves? What is the plan of utilization of cash? Anything that you would return to shareholders?
Right. So we have a three-pronged strategy on the cash that we have on our books. We continue to pay regular dividends quarter-on-quarter basis. We are also investing heavily into our high-end portfolio of business, which is some of these molecular diagnostics facilities and also new infrastructure. And third, of course, as you rightly mentioned, we will continue to look at inorganic options. We constantly keep evaluating these opportunities. As and when the right asset comes in our way, we will definitely deploy funds on inorganic as well. So it's a combination of all the three things.
Okay, got that, Mr. Manchanda. We will leave it on that note for this morning. Thanks very much for joining in. Very quick